Today is Monday, July 28th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. Starting with the grain market this morning, Mark, what will drive grain trading this week?
As we get deeper and deeper into the U.S. growing season, U.S. weather is starting to matter a little bit less. It's still important, particularly for soybeans as we run through this pod filling and pod setting and pod filling stages. Right now, weather continues to look mostly favorable. The very above normal temperatures we're experiencing right now is expected to give way to cooler readings over the next 24 to 48 hours. Week 2 of the outlook does look for a shift back to above normal temperatures. However, over the course of the next 2 weeks, precipitation looks to hold at mostly normal to above normal readings. So I view U.S. weather as a bearish factor. A second crop corn harvest in Brazil is moving along, and right now it's likely over 70%, well below a year ago, but moving along nevertheless. I look for the USDA to raise their current production forecast, which rests at 132 million metric tons. Most private guesses are coming in around 135 to 140. So I look for Brazilian supplies to compete with the U.S. in the global marketplace. And then, of course, we've got these tariff news, August 1st being the deadline for trade deals to be completed before reciprocal tariffs kick in. The weekend announced a trade deal with the EU. It did lack details on potential purchases on U.S. ag goods, while also at the same time here in Sweden this week, U.S. Treasury Secretary Bessent continues to meet with his Chinese counterpart to discuss trade. Looks like the most likely outcome from this week's meetings is going to be another 90-day truce. I think the market is viewing this as a little bit of a price negative as well as we continue to kick the can, their purchases of USA goods down the road. It seems like the markets already seem to be gearing up for a direct meeting between President Trump and Chinese leader Yi sometime this fall.
And Mark, regarding the corn market, how are you leaning, above or below the current USDA estimate?
I'm definitely leaning higher than the current USDA forecast of 181, which is already a record high. There's been a lot of social media reports here in the last couple of weeks suggesting there's been some pollination issues across areas of the southern Midwest. Without a doubt, there's going to be some troubled areas out there. It's a huge growing area, and weather will never be perfect across the entirety of that area. So I do think these trouble spots will prevent us from reaching some of these extreme yields we've been seeing kicked around here earlier this growing season in the 188 to 190 bushel per acre yield. Right now, I'm at 184, which would produce a crop of just under 16 billion bushels, a record. But if that were to occur, I think you're going to see D's corn slip under this $4 level at some point, probably bottoming out. I'm thinking somewhere in this 380, 385 range, late summer into the early fall.
Thanks, Mark. JP, looking at economic events this week, what might traders be watching?
We certainly have a busy week of economic data ahead of us that will give us a better picture of how the economy is adjusting to the White House's trade policy. Most of the buzz will center around the Fed's interest rate decision, Q2 GDP, labor and inflation data, as well as the August 1 deadline for trade deals. The Fed decision, in my opinion, will be a non-event as markets are expecting the Fed to hold rates steady, given the solid labor market conditions and inflation that has remained higher than the Fed would like to see. However, I think attention should also be focused on how President Trump reacts to the Fed decision. He has recently been putting pressure on Fed Chair Powell and the Fed as a whole to cut rates. So I'd be curious to see if he makes any comments on how the bond market will react to that. That decision will come Wednesday. On Tuesday, we get the JOLTS job openings report, which has in recent months surprised markets as employers keep hiring or at least are leaving positions open as they wait to see how the final level of tariffs will impact their businesses. That report will be for the month of July and again will come out on Tuesday. On Wednesday, we get ADP non-farm employment change figures for the month of July. That is followed by the first estimate of Q2 GDP, which is expected to show the economy grow at a rate of 2.4%. In this figure, we are likely to see a steep drop in imports as the front-loading rush of imports and inventory that happened in Q1 really skewed data results for the Q1 GDP as companies raced to get as much inventory into the country as they could in order to get around tariffs. That, of course, showed a negative reading for GDP in Q1, a 0.5% contraction. Then, of course, on Wednesday, we have the Fed decision as well. On Thursday, we get the Fed's preferred inflation gauge as PCE price index data for the month of June. Prices are expected to have grown 0.3% month over month, and that will be for both core and non-core goods, seeing a 0.3% price increase. To wrap up the week, we have the average hourly earnings and non-farm payroll data for July published Friday morning. Payrolls are expected to increase by around 108,000, and earnings are expected to rise 0.3%. The unemployment rate so far has had around 4.1%, but markets are expecting it to tick up to 4.2%. In terms of the Fed, this data will be crucial in determining whether or not a September or October rate cut is still on the table. As long as labor market holds up, firmer inflation may delay the restart of the Fed easing cycle, especially as the final tariff rates are set. We can expect companies to begin adjusting prices for goods accordingly to manage the new cost of their supply chains. Friday will also be the August 1 deadline, and notably, Canada and Mexico are still without deals, so any developments regarding trade with them will surely drive markets.
JP, there's a survey out there called the S&P Composite PMI Survey. Tell our viewers about this and how it plays into the inflation outlook.
Yeah, so the S&P Composite PMI Survey just purchasing managers data, activity really, for the private sector. And it's a good gauge to whether or not to see how private sector activity is holding up, whether or not it's expanding, contracting. A reading above 50 indicates a expansion in economic activity, while a reading below 50 points to a contraction in economic activity. The reading for July, we got 54.6, and that was up from 52.9 in June. That marked the fastest pace of growth in 2025. The uptick in that activity was driven largely by a strong services sector, while activity in the manufacturing sector declined slightly. Notably, though, businesses in the survey reported that employment continued to grow across the private sector. However, they noted that rising wage costs and tariffs directly contributed to steeper input price inflation, which in the survey they reported they then passed on to customers. As a result, output price inflation increased, reaching one of the highest levels recorded over the past 3 years. As tariff levels become set, and given the survey's respondents, I would expect inflationary pressures to continue to stick around and increase into the coming months, especially as businesses see these final tariff rates and adjust their prices accordingly to their supply chains to manage the new duties. Businesses recently have been hesitant to raise prices so far as they wait and see how their supply chains and products are affected by tariffs. But now that there's more certainty in the air in regard to tariff levels, businesses will likely not want to eat too much of those duties anymore. Although they still would like to remain competitive in the price landscape, however, they still want to see their bottom line be as good as it can be and push off some of those costs. So the lack of labor market deterioration so far, paired with the increasing price pressures as evident from the PMI data, could give the Fed little reason to consider cutting rates at its September meeting, especially if we see firm inflation in Tuesday's report.
Thank you, JP. Mark Bowman, looking at the sugar prices, we really recently fell to the lowest prices in the last 4.5 years. What might turn this around?
Well, I think the first thing we look at, the most pressing thing right now is the Unica report, which will be out this week. That'll cover the first half of July. And we had some low numbers in June due to too much rain, and it's been dry there since then. So we're kind of looking for them to catch up or make some significant progress in July. At the end of June, production was down 14% from a year ago. For that period itself was down 13%. Back in May, poll of analysts was saying that they were looking for Brazilian production to be up 18 to 25% this year. So it seems like they have a lot of catching up to do. So if it comes in low this week, that could be one thing that could spark a rally. They did get a little rain there over the weekend. That could slow things up down a bit for the second half. Usually production peaks in the second half of July for the year. Other than that, Thailand has been a bit dry lately, but they got some rain over the weekend, which should improve the outlook there. India's monsoon has been running above average this year, and that's mostly bullish for production. Parts of southern India a little drier, but overall, it's been positive for their crop and their export prospects. The other thing, though, is low prices are starting to attract buyers. We had Pakistan in July earlier this month approving plans to buy 500,000 tons of sugar to help maintain price stability. Philippines and Iran also expressing interest, perhaps, as they see these low prices. And Coca-Cola last week announced it will offer a cane-based version of its product in U.S. stores, in addition to the corn syrup version that they've produced since the 80s. This has already been offered in some markets at a premium price for some time, and that could support U.S. demand on the margins. But aside from that, I would think just the low prices overall, and this seems like this catch-up we have to do in Brazil, it could support a bigger retracement off those lows.
Lastly, Mark, nearby New York coffee prices are 36% off their all-time highs, which were made in February. What factors could support a recovery rally there?
Okay, again, we're in a situation where we've had already a significant sell-off, and this might leave the market open again for new buying. The sell-off the sell-off since February was mostly off of increasing Robusta supplies, which had dropped very low due to problems in Vietnam a couple of years ago, but then they've bounced back this year, both Vietnam and Brazil, both producing a lot of Robusta. But the Arabica crop in Brazil situation there is expected to be down this year. We are in our off season. Last year we were down from the year before, even though it was an on season. So we've got kind of a tight situation there. Still, we had that drought last year that kind of set the Brazilian crop up, Arabica crop up for a significant decline this year. We've gotten a little better though. The rains this spring kind of improved. Basically has lifted some of those worst expectations. And the harvest there is back to on schedule. Safras and Mercado last week said they're 76% complete versus 69% on average. And then we have the tariffs, these 50% tariffs that Trump has threatened against Brazil. U.S. gets about 33% of its coffee from Brazil. Obviously, if the tariffs are implemented, that U.S. prices would go up, but Brazil would be forced to look for other buyers unless there's a carve-out for coffee. But again, with prices already down a third from their highs and Brazilian production down, good chance we've actually put in our low for the time being this month.
Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.